All right, guys, mortgage rates seem to be in trouble, at least in the short term. And that's what we're going to chat about tonight as we answer questions on answer your questions rather on the housing market, on mortgage rates, on everything that's happening that might affect you as a buyer or seller. So, welcome back. It's Wednesday night. Josh and I are here. Josh, how's it been without me there?
It's been quiet. We sit around and with nothing to do. Just have to hammer the keyboard all day.
There we go. So I'm in Vegas at a conference. I'll be back in town tomorrow, but here I am, Wednesday night in Las Vegas, 5 to 6, giving you guys what you came for. And while we're doing this, I know that people are starting to fill in the chat now. Let us again know where you're watching from. Start putting your questions in there. I know there's going to be a lot of questions around mortgage rates. We're going to try to address a lot of this front loaded into the conversation because that's kind of where the market's headed. And I think because of where mortgage rates are, we're gonna see some changes in the housing market, at least in the short term. But Josh, why don't we start by looking at charts as we always do? And we like to start with inventory. So inventory is still increasing. Typically, this is about the time of the year. Again, I keep saying this, when we would see that peak, we're going to see it a little bit. I think when we start looking at the Orange County and Huntington Beach charts, but nationwide, we rose from 732 upwards of 739,000 homes. So we're still seeing that increase, which is, again, the highest level that we've seen over the last couple of years for sure. And then when we start looking at existing home inventory, right? So we're starting to see that existing home inventory climb. And this is kind of the first crest peak, if you will, Josh, that's higher than the most recent peak, right? So we're starting to see it go the other direction, whereas for the last however many years, it's been in a downward trajectory, the last 10 years or so.
Yeah, if you look at it, it's still way lower than what it should have been or has been historically. But when you're looking from like sort of a technical analysis perspective, which you don't really apply to things like the housing market, those lower lows, consecutive lower lows, tells you the trend is still down. And now we're seeing higher lows, and it'll be interesting over the next several years to see what that looks like.
Yeah, and I'm not sure if we have existing home sales in here today because it did get reported this morning. Do we have any charts in here, Josh? I don't know. But
Yeah,
anyway, we're
yeah.
okay. Yeah, we're going to look at that, and we're going to see basically the lowest level of sales, seasonally adjusted that we've seen, and I don't know, maybe ever. I think is it might be at least since the housing crash. But with that said, I think nationwide inventory is sitting somewhere around 4.2 months. Again, it's all relative, right? Have to understand where we're coming from, and we're going to talk about that a little bit more. Orange County, sitting at 3,620 homes. That's down just over 1% week over week. Huntington Beach at 230. That's down about 4.35% week over week. So have we seen the peak in Orange County and Huntington Beach? My guess is if not, we've got to be very, very close to it. I think this rise in rates recently, seeing homes come off the market, I think we're probably towards that peak for the year. But again, we need more than 1 week to be able to justify whether or not it's a trend. 1 week is not a trend, believe it or not, but we will, continue to watch it and continue to update you guys. New listings sitting at 60,361 new listings this week. Unsold listings. I don't have the immediate sales, but we always have, properties that are new listings that go immediately into contract. Again, this is weaker numbers than we saw last week in the same report, but it's typical, right? We start to see the new listings, the market slow down as we move into seasonally adjusted that time of the year. So existing home year over year, Josh, this is what we were talking about a minute ago. Anything you want to add on this?
No, just looking at where people like to focus on the year over year change in inventory, and it is high. It's higher than what we've seen, all the way back to the GFC in that 2006, 2007 timeframe. The red line is probably a little bit more important here, shows that we're getting back into that range of, like you said, 4.2 months right now, that 4.5 months. If you go back and look at 2015, 2016, 2017, 2018, those were years where we had appreciation, but it wasn't this crazy runaway appreciation that we've seen over the last few years. So if it settles in here and doesn't pump up to that 6 month range, which is largely going to be dictated by affordability going forward, which a month ago we thought we had under control. But we'll get to that when we get to interest rates.
Yeah, and it's interesting. Like we here again, I'm at a real conference, a real brokerage conference here in Las Vegas, and one of the speakers today is actually Leslie Appleton Young. I believe that's her name. She's an economist for California Association of Realtors, and a lot of the information that we're talking about tonight, she talked about earlier today. And she was very talking about inventory picking up, but also very quick to point out where it was prior to the pandemic, how we're still below that time frame, and how lower rates are likely going to lead to more sales. And she showed a lot of charts with regard to what different organizations and different people are predicting with regard to rates, with regard to sales over the next year, over 2025. And we're going to talk about rates, but her analysis and her stuff says that the majority of people think rates are going to be in the fives, and she agrees with that in 2025. Where in the fives, hard to say. She does think that's going to lead to more people selling, but her whole take is, again, rates aren't going to be low enough, probably for the majority of the year, to unlock enough of that inventory to really have a huge impact on the housing market, right? Yeah, we're going to see more and more, but it's still going to be probably below those pre-pandemic levels in many facets of the business because of that lock-in effect. So total contracts pending, 357,675 compared to 324 back in 2023 and 343 in 2022. And then that is going to take us into, again, existing home sales. We talked about that earlier. I think we're sitting somewhere around 3.84, I believe, Josh, is the number, seasonally adjusted. If you're looking at this chart here, the lowest level that we've seen since basically 2010. So, not a lot of sales happening.
That was just a blip there in 2010, Jeb. And this is, hey, we're going to talk a little bit about the election tonight and what the markets are thinking about it. But that dip in 2010, you're like, wait, in 2010, why did sales dip so much when we had the big collapse in 2007, 2008? Well, that was because the government in their infinite wisdom said, hey, what we're going to do is no one's buying homes. We're going to give them a tax credit to buy homes. So it pulled forward a bunch of demand into 2009. So we had more sales in 2009, and then it fell off a cliff in 2010. So when we're hearing Kamala talking about, hey, we're going to give $25,000 to people to buy homes, first of all, incentivizing something makes prices go up when things are already unaffordable. And what it does is it doesn't create new demand. It moves demand around and causes market distortions. So that was interesting seeing that dip.
If I'm being honest, Josh, and we'll talk about this, if they came out today and said we're giving a $25,000 buyer credit to buyers to buy right now, I don't think it would do anything. I truly don't. In some
I think you're cuckoo. It wouldn't make a market frenzy, but it would absolutely move the low end purchase price.
It would move the low end, but like where we are, there is no low end, right? So you got to look at the markets with the low end, right? It's locality is clearly a thing, and yes, it would have an effect. I'm not being naive to think it wouldn't, but I don't think it would have this gangbuster effect where the market changes. And no, I just think affordability is too out of whack. Rates are higher than most people want to see, and people would wait. They would wait, and then it would be gone, and then they wouldn't have an opportunity. But neither here nor there. Existing home sales, Josh, this again goes back and looks at bubble times versus different years in the market, and essentially where we are right now. And anything you want to add on that one? This is non-seasonally adjusted. I realize that. Yeah.
So you and I talk about this all the time. Like those black bars, those are abnormal. It doesn't mean that the current market is normal, but somewhere beneath those black bars, those are like the best years, close to the best years that the market has ever seen. But you're looking, we had seen early in the year, Jeb, when you and I did the forecast back in January, I thought we would get to somewhere close to 4.5 million sales, and we're at like 3.85 pace now. And it's all dependent on affordability, which affordability was trending in the right direction. We saw a bunch of increased application activity. We saw increased demand for a brief period of time. We need to get rates lower, affordability higher for a sustained period of time. I mean, we really had about a month worth of rates where people were feeling like, okay, this is starting to get affordable. We need that for 3, 4, 5, 6 months to get back.
And then bam. and then bam, it's gone. Like, just gone. Again, inventory went from 732 to 739 last year. Same week went from 546 to 554. So you can see the difference there, up what, 35% or so. Actually a little bit higher, maybe 38%. All-time low was at 240. All-time high is where we sit right now, or at least for the last 5 to 6 years, sitting at 739, 434. Context, taking us back to 2015, we were sitting at 1.171. So almost, close, you could say 1.2-ish, somewhere in that ballpark. So we're still well below that. But, as rates stay higher, if this were earlier in the year, inventory would probably pick up a lot. But I think because we're later in the year, seasonality, some of those things, you naturally have that runoff effect anyway. And so inventory is not going to increase at the level that it would have in another part of the, another time of the year. But it's we'll see, right? Percent of properties with price reductions, 39.51% compared to 38% in 2023 and 42% in 2022. So, but we're creeping up. And again, depends on the time of the year. Have we peaked yet or not? But we're probably pretty close to that seasonal peak in price reductions. What are we looking at here, Josh?
We talk about often median. We don't love median just because it's distorted by the mix of sales. As prices go up, more people buy cheaper homes, so it can show a number there that is sort of skewed. But you can see here that the correlation between median price and Case-Shiller, which is a paired sales, repeat sales index, they're pretty consistent. And you can see that Case-Shiller follows pretty closely behind it. So I think it's another week or so before we get the Case-Shiller data. Definitely trending down. But no one should be panicking about that. We should be celebrating that. You can't have years over years above 5% appreciation. We need a period of time. It would be nice to have 2, 3, 4 years, somewhere between 0 and 3% appreciation in home prices while interest rates normalize and wages increase.
And speaking of, Leslie, that we were talking about earlier, Appleton Young from Carr, she said, she showed a chart of appreciation predictions, forecasts, if you will, for 2025, and it went anywhere from just above 0.9% or something like that, upwards of like 5%. I think the average between like 11 or 12 different organizations was probably about 3.5% in appreciation is what they're expecting in 2025. So just for context.
All right, Jeb. So we'll get to the fun discussion here on interest rates. This is from David Rosenberg put this out this morning, and it was funny. I saw almost the exact verbiage in someone else's report. So either they read him or they were both thinking very similarly. So the factors impacting the recent bond market trends. So the bond market has succumbed to a variety of forces over the past month. One, the Fed moved too far in its recent rate cut. I don't necessarily agree, but in retrospect, they surely could have done a quarter point and been a little more measured in their pace there. A reassessment of how much more easing is needed. The funny thing, Jeb, you go back 2 jobs reports ago and people were calling for a panic intermeeting Fed cut. And now we have one last month that was largely impacted by seasonal adjustments. You take away the seasonal adjustments from last month and we had a negative jobs report, but now we got to go much slower. This economy is really, really strong. A string of better than expected economic data and investors latching on to reflationary trades they think will work in the event of a Trump win. So we don't talk about politics here, but we do talk about the things that are impacting interest rates. And it is undeniable at this point that some market sentiment, some somewhat crazy market sentiment is considering a Trump presidency to be likely to be inflationary, which the funny thing is we've seen the Trump presidency. He hasn't changed what he wants to do.
Yeah, but explain, like, it's not just him winning. It's the whole, it's getting both, House and Congress and being able to basically pass anything through, right?
100%. And we've talked about this before. Like, if you're a Trump supporter, but you also want a reasonable United States and functioning markets, you should hope that the Democrats can hold either the House or the Senate. When we've seen crazy legislation go through from either side that people hate, that no one likes, it's a time when generally in the first 2 years of a president's term, when they get the House, the Senate, and the White House. And with that, if you look at Polymarket, these other betting markets, they're all right now pricing that in. And it's kind of crazy. It's been a little bit bipolar, right, Jeb? In the summer, everyone is like, oh my God, Biden has dementia. This is going to be a red wave. They're going to run away with everything and they're going to be able to do whatever they want. And then we go, no, we replaced it with Kamala. And for about a month, Kamala was the greatest thing ever in the history of the world. And there was no chance that the Republicans were going to get buried. And now we swung all the way back to the other side that they're in trouble, that it's going to be a red wave. I have a feeling it's going to be a lot closer than people expect. And I am holding out hope, while not telling you which side I'm voting for, that we at least get a split House and Congress there. But what I was saying is, we've seen 4 years of a Trump presidency, including he had a red wave the first 2 years, and that's how he was able to pass those tax cuts. So from that perspective, this whole idea that Trump is somehow more inflationary than Kamala is insane. We've talked about this repeatedly on the show. Neither of them have a plan for reining in spending. So depending on whose partisan numbers you look at, one or the other will add more to deficits and more to inflation than the other. But we as voters should expect more from the people that we're going to vote for, no matter who that is that you're going to vote for. This was from Matt Graham, a previous guest of the show that we follow very closely. So the peak we all know was at 5% in rates. We had a nice dip last Christmas season, and then a run back up to 4.75%. Then an even better dip. We talked about these lower lows. We had a lower low there, and now we're going back up. And if we want to see this downtrend stay in place, we need to see a lower high, and that would mean this petering out somewhere around 450. David Rosenberg ran his numbers, and it was like 445, and had another person looking at it 438, 439. So somewhere not too far away from where we're at, we need this sort of craziness in the bond market to peter out, and it's going to definitely take getting past the election, for one, and then number two, some negative economic news. This is the one that we show you guys every week, and what I wanted to show you here. So the green down channel we looked at, and we'd even talked about this in the show, that is an aggressive move down in a very short period of time, especially when we had the big dip there where we broke out of the bottom of that green channel, and you're looking at it going, this is a little too much too fast. So then you see it give back, and we drew the yellow channel, still a down channel, but a less aggressive slope and probably more sustainable. Well, in the last week, we've lost that. So now you're looking at that top red trend line. It's the same one that we have here in this chart in the white line. That needs to hold. As long as it holds, this is kind of normal and somewhat to be expected, despite the fact that it's been a bipolar sort of head fake market that they just can't make up their mind what they think is going to happen. So over the next couple of weeks, we have some big pieces of information. Tomorrow, we get the weekly claims. I don't think there's anything coming out Friday, but starting next week, we get JOLTS, the job opening labor turnover survey. Then we get ADP and the first look at GDP. Every analyst that I follow is looking at the numbers, looking at the Fed beige book, looking at all of the private data and saying, this feels a lot like a 1.5% economy, yet we keep seeing these numbers that the Fed puts out that is in direct contradiction to their own beige book, where they do the survey of all of the regions that the Fed serves and look at it and go, it's a pretty slow economy, but then we're looking at 3% growth, and it'll be interesting to see where that shakes out. We get the jobs report on November 1. Of all of these, that jobs report is probably the most important one in light of the shockingly strong number last month with those big seasonal adjustments. November 5th, we get the election, and 2 days after that.
Do we really get the election on the 5th, or is it going to be like the 6th or the 7th or the 8th? I'm asking because, I think the likelihood of it actually, unless it's just a runaway, which I don't think that it's going to be, I think it may not be the 5th. So we'll see.
Again, Jeb, it goes back to this bipolar nature of the reporting that we're getting. In the summer, Trump was going to run away with it. And then 60 days later, Kamala was going to run away with it. And now they're back to Trump is going to run away with it. I have a feeling that you're right. All of these elections come in pretty much 50.5 to 49.5 in the popular vote. This was a headline in Market Watch yesterday, and there was probably 12 of these articles. It's funny. You talk about how when the media latches onto something, you see the same article 15 different places, but red wave risks are helping drive up the 10-year treasury yields. And then the fun one down here, Jeb, rising bond yields reflect solid U.S. economy in addition to the risks of a red wave election. So I wanted to throw this in here. This is in one of the reports that I read every morning, and he points out in Bloomberg, these headlines were linked right on top of each other this morning. Treasuries plunge like it's 1995 as traders see a soft landing. And then the very next article is IMF lowers global growth forecast, warns of increasing risks. So it's not just us. Like, it is hard to get a handle on this because you could get not just slightly differing opinions, like diametrically opposed opinions on what is happening in the economy. Through this chart in here, Jeb, this is interesting. If we go back, again, depending on how you vote, you may or may not like this, but let's look at under Clinton. We actually got to a surplus right there before Bush came into the office. We had to finance wars, so we got to a little less than $100 billion a year of deficits. Under Obama, we had the great financial crisis, so lots of stimulus, and we started running big, or what we thought then were big deficits at about $300 billion annually. Kind of normalized up into that 150 range. When we say that's kind of crazy when you say it normalized at $150 billion a year deficit. But under Trump, the early part, it had gotten worse to about $200 billion deficit, possibly could be attributed to his tax cuts, less receipts there. And then COVID hits, and we know what happened there. But the big thing here is in 4 years under Biden, it's never got back even in the ballpark of where it was. So from that perspective, that gives you an idea that through Bush, Obama, Trump, Biden, no one has been all that concerned with the deficits. And during this election, we've seen lots of ads about abortions. We've seen lots of ads about like 3 or 4 topics. None of them talk about spending. And when I talk to people, that's far and away the biggest concern is how do we get this deficit under control? And that, to me, is what the market is looking at and is thinking is inflationary. I threw this in here. This is basically 2016 to 2020. Those are the 4 years of Trump. Came in with inflation, core inflation just over 2%, went down as low as 1.7 and left about just a little over 2%. So again, to me, it's funny when we're looking at Trump's going to be inflationary when the policies he is proposing are not changing relative to what he wanted to do then. Threw this in here before we jump into rates, Jeb, just looking at the spreads are holding. 2.4 is not a great level for us, but I was worried that when rates are up 0.8% over the last 3-4 weeks, that we would have given back more of this. So the spreads are holding at a lower level. If and when we do get rates take another trend down, this will probably start normalizing down towards that 2% range for us. We were happy for weeks and months on end when all of these pretty arrows were green. We pretty much got nothing green here other than the year over year. So rates are about 1% lower than where they were a year ago, because last October we had hit basically the highest levels. Back up close to 7% on a 30-year fixed for your typical borrower, FHA and VA in the low 6s as of now. So all that refinance activity has come to a screeching halt, Jeb. We have a fun tool for those of you who missed the window, who were thinking that it was going to be a straight line, that rates were going to go down, and are now worried, hey, I'm never going to get the opportunity to refinance. We have a tool called Strike Rate, where we get some basic information from you, basically how to contact you so that we can have a 5-minute conversation, go through your situation and say, where do rates need to be before this makes sense? And this system, we put you in there with your loan amount, your interest rate, your strike type, your loan type, and this monitors that, and it will trigger us to reach out to you as soon as you have that opportunity.
But it also triggers them as well, right?
I don't think it does. I
Okay.
thought it was supposed to give them a notification, but it pings us to reach out. So I get an email that says, hey, Jeb is eligible as of today. And had a conversation with a listener. It was actually a listener's daughter had reached out on his advice, and we went through it, and they're at 6.375. We could have got them to maybe 5.625 at the lowest point. And so we said, 5.75, 5.625 is where we want to at least reach out and have that conversation. It wasn't a huge loan.
Yeah.
So it's like, maybe you don't decide to do it then, but it's hard for us to say right now when rates are in the high 6s, what your thought would be at 5.75. But we probably should start having that conversation, and we might adjust or move that strike rate of where you actually want to pull the trigger and give it some time to go. And what I'll do, Jeb, we have we have another form that will allow you to actually upload your mortgage statement. So I think I have a banner in here. Let's swap that one out just for a second. This is on the podcast website. It goes through the same system and pumps it in there. So basically just going to gather your name, phone number, email, and it gives you an opportunity to upload your mortgage statement there where we can put you in on that strike rate. And again, it's like a 2 to 5 minute conversation just to say, okay, where do you want rates to be when we reach out, and then start having that conversation.
And for those of you listening, it's theeducatedhomebuyer.com/P/rate watch, one word. So theeducatedhomebuyer.com/P/rate watch will get you to that. And then following up, the states where Josh can help, all of those states that are currently red on that map are where Josh is licensed to do business himself. Our team can help you. Blue is where we refer you to David, one of our lending partners who can guide you in the right direction. So if you need help, you're going through the process, you want to just see where you are, that's the best way to get in touch with us. While we were doing that, some of you guys put comments or questions in the chat. Some people with comments. If you have questions, put them in there now so we can get to them. We have about 35 or so minutes left on the live, and it's really all about you guys providing value, giving you the information that you need so that you can make educated choices. So with that, as we start to see the questions, we'll answer them. At the same time, let us know where you're watching from. We got a Canadian real estate channel here, basically just saying great breakdown. Appreciate it. A lot of Canadians here in Vegas at the moment at the Real Conference. You guys have a crazy squad, good agents, great people. So yeah, good stuff. We got RR saying you guys rock. Appreciate it. The reason I put these up there is because we get so many shitty comments from not on here but on videos that, hey, it's always good to see that we're doing well, that people actually value the content. So we appreciate you guys, but let's see what we got here, Josh. So we don't really have a lot of questions per se. Here we go. Here's one. Have we seen the peak for 2024 rates yet? I don't think so.
It sure doesn't look like it.
I don't think so. I think the volatility between now and some of those dates that Josh mentioned earlier, just a bit ago, between the jolts, the ADP, the GDP, the election, all of that, right? CPI coming out the following day or 2 days later or whatever. Those are all very important and can definitely determine what happens in the market. Unfortunately, the data at the moment is not supporting lower rates. And until you see something, which again, we're a week out at least before we see anything, you're not going to see. There's no reason for rates to move lower, unfortunately. The only thing that could happen is potentially some sort of global, war type thing, but that causes other issues with oil and other things that can cause bonds to spike. And so, no, I think rates are probably going to trend a little bit higher. Are they going to go a full % higher? I don't think so. No, I don't think we're there. But could they have a 7 handle on them on a site like Mortgage News Daily? Probably. I think we're not far off. 6.92 today. Could you see 7% tomorrow or even Friday? Sure. I don't think that's unreasonable at this point, Josh. But anything you want to add on that?
So I think we answered the spirit of his question. The peak for 2024 rates. Remember that the first half of the year, rates were higher than where they are right now. We didn't get to this level until July. So for the second half of the year and relative to where we were, I don't think rates have peaked between now and the end of the year. So if we go back and pulled up that slide, we're at 424 on the 10-year right now. I think very likely we go to at least 433. And if 433 gives way, you've got a little support at 445, and likely you touch that 450. We won't bore you guys with what Fibonacci regressions look like, but those all end up being really important support levels in terms of the Fibonacci. And it's important that we gave up the 200-day moving average. The 200-day moving average is a pretty long-term indicator, and we were below that pretty much from June all the way through last week. So it tells us it could be a couple of months. And if you look back, most people don't remember, but the first several months of the Trump presidency, when the market was going, what's going to happen with these tax cuts? Rates definitely went up before starting to come down. And that was the time when Trump was having arguments on Twitter with Powell. Then Fed needs to cut rates. Fed needs to cut rates. So I think you probably should be prepared for 2 to 3 months of elevated rates before we do. At some point, we're going to see a slowing in the jobs market, and that will give the Fed the cover that they need to continue with the plan that they said in last month's dot plots of what they were wanting to do.
All right, we got Martinez here asking, "Is this the best time to buy or sell?" And here's what I would say: you're moving into the slowest time of the year. You're going to have less listings on the market, traditionally speaking. You're going to have higher rates because of what's happening right now. If I were a buyer, I would probably hesitate a little bit just for the time being, unless there was an opportunity, right? An opportunity where you could get a property that was maybe discounted because the seller has to do something. You found the right property that hasn't been on the market in some extended period of time, and it all makes sense. Then I would probably do it. But if I were selling, I would probably hold off right now. I don't see any reason if I were a seller, unless I needed to sell because I was financially in a position or I had to do it because of something else. I think I would probably hold off personally until beginning of the year. And that's twofold. One thing is just where rates are, you get less buyers, you get a lot of things going on there, but it's also a time of the year where this isn't the best time of the year to put your home on the market, just from seasonality. And so I would probably hesitate a little bit and just kind of watch and see what happens. But to each his own, right? There's always opportunities. You just got to see them and take advantage of them if they make sense. And if they don't, then you wait until they do. So, Josh, Bill saying, is it your turn to go to Vegas convention? So
I hate Vegas. I hate Vegas with a passion. It is my least favorite city on the planet.
Actually, this vacation wasn't, this time Vegas wasn't bad. We're not really in a big hotel. This is the Virgin Hotel. This is where the conference is. This used to be the old Hard Rock. But it's not really near the strip. It's kind of secluded. Really the only people here are the people from the conference. So it's pretty much a hotel full of people that or you're going to meet at some point anyway. So it's actually been kind of nice.
If it was still the Hard Rock, Jeb, and they still had Mr. Lucky's Cafe in there, and at 2 a.m. you could roll in and get a plate of wings and French toast, then I'm in. But other than that, I don't know that you're going to get me to Vegas anytime soon.
Dude, I think you can, if you spend enough money here, you can get anything you want, Josh. Delivered at any time. Anytime. Let's see. Chatty. I paid my primary house in full. Is it better to do a cash out refi to buy a second property or to finance the second property conventionally? Thank you, guys. So, Josh, what are your thoughts on buying a second property? Now, it's obviously second property can mean a couple of things, right? It can mean a second home. It can mean a new primary home. So I think kind of break it down both ways and see what makes sense.
It's going to make a big difference, because if you leave your current home and you're going to keep it and the new home is going to be a primary residence, you'll get very good terms on that, better than you would most likely on a cash out refinance. Now, that's assuming that you have the down payment for it. Now, if it's a second home as a vacation home or truly an investment property, either one of those are going to require a good sized down payment, and they're both going to have higher interest rates. About 2 years ago, the FHFA told Fannie and Freddie that they need to match loan level price adjustments between investment properties and second homes. So despite the fact that I would think a second home would be lower risk, FHFA no longer follows risk-based pricing. They say, let's follow social justice pricing, and we shouldn't be making homes affordable for people to buy second homes. So let's increase those costs so that we can subsidize costs elsewhere versus actually measuring the risk in those loans. So it does matter from that perspective that either a second home or an investment property is going to have a higher interest rate. So if you look at that, if one's going to be a primary and the new one's not going to be a primary, that's probably going to be your best bet for how to finance.
Awesome. Don't really have a lot of questions here, so I'm just gonna, until you guys put some questions in here. We've got Lydia from Phoenix watching, G Money from Savannah. We got Point Given from Westchester County, New York. So we got a big variance here. Got somebody I went to high school with in here, Josh. What else do we have? We got Phoenix again. We got Minnesota, MQ from Minnesota.
New Jersey.
What else? New Jersey. Josh, why do you hate Vegas?
It's the worst.
Yeah, he's against sin. That's it, Joyce.
Exactly.
It's Sin City.
They don't have good churches.
Sin.
They do not have good churches in Vegas, so I'm not down with that. The traffic, the 9 billion people having to walk everywhere, the 9 billion people. Did I mention the 9 billion people?
This guy. We got Seattle. We got Machine Gun Kelly in here. Look at that. MK. Yoruba Valley. Anyway, let's do this. We got Nico saying, considering selling your property, buying a new one as I move from London to Ottawa. Just want to get your thoughts on this. Do you think it's a good idea now, rent, sell later? I don't know Canada well enough. Some of the data that we saw today from the economist that I mentioned earlier, she basically said, when you're looking at Canada, kind of look at it like the US in the sense of cyclical and what is likely to happen. So in her opinion, rates will continue to trend lower into next year at some point, which is going to get some more sales, and you're probably going to have appreciation continue to go up annually. Now, is it going to be 5+% annually? No, it's going to be probably in the low single digits. So if that is accurate, do you wait? Do you whatever? And so if I were selling, I think it's the same conversation that we were talking about earlier. I would wait. I don't think, again, Ottawa, Canada, different markets. So you're moving from London. So are you selling in London and moving to Ottawa? I'm assuming that's what you mean there. I don't know what it looks like in London. I don't know what time of the year. All of those things they matter, right? So here in Southern California, or where I am at in Southern California, the market does slow down during holiday season. I use holidays in quotes because it's holidays. It's not a winter market, but there are some markets that stall out when it gets cold, right? I'm assuming parts of Canada and some of these other markets, when it gets really, really cold, you can't sell real estate to some degree. And so that would impact whether or not I would put it on the market now or wait for things to thaw out, right? So that's why you got to talk to a local pro on that sort of thing. If you were talking in my market, I could guide you. I'm not there. I know agents in Ottawa that I could refer you to. London, I don't have anybody, but if you need help, reach out and I'll do the best I can to guide you there.
How far is it from London to Ottawa? Aren't they relatively close to each other?
What's that?
Aren't they relatively close to each other?
I have no idea.
You're not up on your geography of Canada?
No, I'm not.
All right.
How are they close to each other?
I'm going to Google it and see how close they are. Yeah, not far. Well, I'm dumb. 5 hours, 54 minutes. It's 576 kilometers. So I think you're definitely going to have to refer them to
what do you mean by
two
close?
separate agents.
Yeah, here we go. Anyway, let's go into, do we have any? We got another question here. Some of the Antonio's asking, which loan is better for the same house? A $325,000 loan with a 6.8 interest rate, no closing cost assistance, down payment is FHA 3.5%, or a $363,000 loan, no down, closing cost 0, using a USDA loan, interest rate 3.625. For me, no brainer. I have 363 versus 325. That's a completely different property, right?
Yeah.
How are we talking about two different properties?
Where are we getting a 3.625 interest rate? Are we assuming a USDA loan? I'm just thrown off all the way around.
Yeah, I don't understand how the same house is a 325 with 3.5% down and one's 363 with no down, because there's a bigger variance there. So let us know. We'll try to answer that. What kind of interest rate are we looking right now on FHA, Josh? Somebody that's got, say, above 680 credit score. You're most well qualified.
Clinging just below 6%, 599, 5.875, maybe.
Okay. And someone asked earlier, Josh, VA. I don't remember the question specifically. I'm trying to find it here. Oh, best educated guess where VA rates can be essentially 2025 after 2 more rate cuts. So
we say at the beginning of 2025, well, what are we talking about? Like, it sounds crazy. We've got 70 days left in this year. So it's 2 months. If we go back and look at that chart and the uncertainty around the election, Jeb pointed out that we may not have certainty the day after the election, but by the end of the year, we're going to know who's getting inaugurated in January. But again, if you look, that whole first quarter of a new presidency is sort of clouded by the market going, what are they going to do? What impacts is it going to have? What is it going to look like? I think we're going to sort of have this cloud of uncertainty until the middle to end of the first quarter, unless you see a big weakening in the data between now and then, which I don't discount the possibility of. So I wouldn't count on things being better. I would think likely to trend a little bit worse and then just kind of flat in this same no man's land where we've been for the better part of the last year and a half.
All right. We've got a question here saying, "What's up, fellas? Been in contract since mid-August. Basically was at 5.625 at that time, with a closing date in mid-December. It's a new build. Rates are now 6.5%, which essentially knocked them out. It sounds like of being able to qualify. They go on to say, is there anything the seller can do to get me my preferred monthly payment? Otherwise, I will have to back out, and I don't think builder wants to lose out on a buyer." So Josh, we talk oftentimes about builders giving incentives to buy down interest rates, but I think it's relative, right? If you are in a community where there's no inventory, everything is sold, probably a little bit more difficult to get that seller to do anything. In the case that there's inventory, they got new builds that aren't under contract. It's not, it's all spec building type stuff. Those are where I think you got more of an incentive to get the builder to do something. But is there anything we're missing here, Josh, that could potentially help them?
Well, the big thing is that it's a Cal HFA loan. You can't buy down a Cal HFA loan. They tell
Oh,
you
well, there
on
you go.
this day, this is what the interest rate is. And when they post it, you're going to lock it. And they only offer certain lock periods. I don't know if they even offer extended lock periods. We don't do a whole lot of them because they're not really good loans for most people. If you can come up with the down payment, they could cover all of the other costs for you and easily buy that rate down to 5.625 on an FHA. I mean, it wouldn't cost them that much money, but like you said, Jeb, it just comes back down to supply and demand. If they have more demand for the homes there than their supply, then they're just going to put it back on the market and sell it potentially to someone else.
And you potentially lose your deposit if you have one in there. So that's the other side of it, right? So there could be losses on your side, or an impact on your side more so than on the other side. Taylor asked a question here that I guess we didn't see. Says currently buying a house, 355,000, 6.875, 30-year, 5% down, no PMI, 4%, 4,000 closing costs, 3,500 in seller point credit. So I don't see a question. Is there a question associated with that, or is there just a comment? Is that a decent rate for amount of points paid? So do I need to put that back up there, Josh? Did you see it?
Yeah,
Did you?
I don't.
So I'll put it back up there. There we go. So essentially, paying 4,000. Well, they're getting 4,000 closing cost assistance. So they're paying $3,500 to basically get a 6.875. Is that a good deal?
So seller point credit. So the seller's paying that. If the seller's paying it, who cares? The rate is average, but no PMI is valuable, and $4,000 of assistance on that loan. It's basically they're giving you a little more than 1%, which is the equivalent to maybe 0.25% in interest rate there. So I'm a little thrown off by 4,000 in closing cost assistance and then 3,500 in seller point credits. If they're giving you assistance, then they're just charging it in points. It's kind of a wash. Overall, generally, when you see these programs that some credit unions offer, they're good, not great. I look at it. I don't look at it and go, "Oh my God, that is an amazing loan." But I look at it and go, "It's good. It's good." You look at the monthly payment; it's not going to be bad at all.
All right, there we go. Maria says, "I need to sell my house and buy another house. Do I have to pay two realtors in the process and need to be the same realtor to buy and sell?" So let's start with the second part. It does not need to be the same realtor to buy and sell. In the case that it is the same realtor to buy and sell, there's probably an opportunity for some sort of discount in compensation. But typically, the answer is yes. You would pay an agent to sell your house, and you would pay an agent to represent you, and or get the seller to cover that cost in some fashion, right? Or at least pay part of it. So there's a couple different strategies there. Essentially, four ways a seller can pay for compensation, or compensation can be paid rather. And so, if you're buying in the same market, I would almost tell you or try to persuade you to use the same agent to help you buy, because I think there's a greater opportunity there for negotiation on your part. Hard to say 100%, but either way, if you need assistance, you need a realtor, you want to talk to somebody to buy or sell or whatever, use that referral link. Happy to connect you with somebody I know. In fact, I'm networking with 1,000 agents here in about an hour. I have a white party tonight, Josh. I'm wearing all white.
That sounds
You
fun.
should see.
That sounds
You should
fun.
see these pants that my wife ordered me off Amazon. These things could fit a much smaller man than me.
So it's like your normal shorts that you wear.
No, not short, tight. I don't wear clothes like this. And let's just say I look like a millennial. So with There might be some pictures floating around the internet later this evening. If you don't follow me, you probably should, and I'll show you. But nevertheless, so we don't have a lot of other questions here, Josh.
Willing has a
Am I missing?
question, Jeb, that's going to
Yes,
allow
sir.
you to pitch a video that you recently did.
All right, let's
How
see.
can some lenders promise that a borrower can do a refinance and not charge them any closing costs when they come back down the road? Lost a deal because of that. Willing is either a processor or a loan officer for those of you who don't watch every week. But Jeb, how do some lenders have this magical ability to promise people free refinances in the future?
Because they essentially overcharge you on the refinance by either building it into your loan, giving you a higher interest rate. There's multiple ways that it can be done. But at the end of the day, there's no free lunch in refinancing and anything. There are costs that are paid. It's just a matter of how they're getting paid, right? So if you're not paying them, then you're either getting a credit from the lender to pay them, or they're being added to your loan amount and you're paying them that way. Or in some cases, you're taking a higher interest rate than you might otherwise take or might otherwise be able to get. And maybe your closing costs are being paid in that fashion. So, what we suggest in those cases is if you're refinancing, you have questions, reach out. Like, I mean, Josh talks to people all the time that, hey, this is a good deal. Like, you're getting a good deal. We've gotten like 5 or 6 people, Josh, per day over the last couple of days. Like, it's been crazy the amount of people reaching out as rates have trended up, which is kind of odd because when rates were low, we got a lot of business, but now rates are getting higher. I don't know if people are panicking or what the hell's going on, but the number of people reaching out has been quite high. So there's a lot of people that have the same question. If you have it, reach out. We're happy to help. That referral link will guide you in the right direction.
There's a couple of things, Jeb, that I like to say in this. We've done multiple episodes of the podcast on red flags. Anyone that sells you this line of bullshit, that's a red flag. Because I look at it this way. Let's say you're a reasonably productive loan officer. You do 3 loans a month. So 50 loans in the course of a year, and rates have been where they were for the last year. Well, last month, you would have had about 50 clients calling up for their free refinance. You don't have the ability or capacity to do 50 loans in 1 month, and you certainly don't have the capacity to do them for free. So it flies in the face of logic. Exactly what Jeb said. It's a no-cost refinance, which everyone has had no-cost refinances forever. They just tell you when you get, I will do a free refinance. They're not doing a free refinance. The other one, Jeb, that is a pet peeve of mine, direct lenders, a handful who will remain unnamed, that have horrific interest rates that are 3/8 to 0.5% above where the market would be, worse than that on FHA and VA loans. They'll tell you, oh, we guarantee we'll close your loan in 10 days. So, okay. So they gave you a pre-approval letter that says write a 10-day contract, will close in 10 days. Most sellers don't have any ability or interest in packing up their house and getting out of there in 10 days. There's not really a need for it. And the only way to have the capacity to do that is have rates so shitty that you just have underwriters waiting around for a file to underwrite. So if you have a need to close a loan in 17, 21 days, absolutely doable. 10 days is doable, but there's no reason in most situations to be running around talking about a 10-day close. And the only reason anyone does it is sort of a shell game to keep you from looking at the thing that you should be looking at, which is the terms of your loan.
All right, good stuff. Let's see here. We've got a question, Josh, asking about a VA loan, 465,000 at 5.75%. I don't understand the rent part. I'll be paying 1,300 out of pocket until I refinance when rates hit 3%. Then I should break even. Thoughts, Jen? So if you're waiting for rates to refinance, you're not going to refinance anytime soon, unless I'm missing something here. So basically you're paying $1,300 out of your pocket because somebody's rent. I don't 100% know here, but chances are you're going to be paying that 13 out of your pocket for quite some time. Because rates aren't going to hit 3% anytime soon. Now there's an opportunity, rates were under 5% on VA a couple weeks ago, Josh. You could have taken advantage of a lower rate there. That would have saved you some money. It's not 3%, but there's opportunity. So what I would suggest is Josh, you got to keep that website up there where you go there, put your strike price in. So those of you just tuning in now, Josh introduced a website earlier in the show, which we can put back up here on the screen just for a moment here so you guys can see it. and see what it does. Basically, what this is it's an opportunity for you to go to that website that's just below Josh's face there and just below the website, theeducatedhomebuyer.com/P/rate watch. Put in your information. And what this is it's an opportunity for Josh to know where your interest rate is now, what your loan amount is, what rate you're interested in. And as rates get close or to that, exact rate, Josh then has basically a call to action to come out and reach out to you. And that way you don't have to sit here and watch where rates are every day, right? It's somebody doing it on your behalf, which honestly is the way that it should be, right? Because if you watch this every day, you'll go crazy. It's crazy for us to watch it every day. But have a source like this, even if it's somebody else, that's fine too. But either way, get on somebody's list so that they can reach out, so that you're not having to ask the same question week over week.
And ask them if they have a system for it, because I can tell
Yeah.
you it's really hard without that tool. I have sort of a spreadsheet over here that we've kept. And I'm very happy to have got that access to that tool in the last couple of weeks here, because having to have a spreadsheet and try to remember everyone who has the opportunity or will have an opportunity when rates hit a level, it's different versus just an email in the inbox in the morning going, hey, this person, the rates have hit the level that they need.
I guess I'm really fascinated, Josh, by the number of people that are reaching out, looking at rates in the mid to high sixes, asking, hey, is this a good deal? Like, where were you? I mean, I'm not pooping on anyone here, but where were you guys last month? Like when rates were in the low sixes and for VA and FHA were in the low fives, even high fours to some degree. Like that was the time. Can it still make sense? Sure, it can make sense, but that's why it's important. That tool that we just mentioned a moment ago, that's right there on the screen, is very important for not missing opportunities. Right? There's an opportunity cost, right, in everything, and one of those opportunity costs right now is missing out when it actually makes sense to refinance, waiting for something else to happen. And so, yeah. Anyway, that website.
If you 100%, like Jeb, the biggest conversation, well, I'm going to hold off. Rates are going lower. I'm going to wait. Doesn't make sense to do it. I'm like, well, you have a $325 monthly savings on a no cost refi. Yeah, but they're going to go lower. I don't want to have to do this a couple times. So when rates are going down, and for the better part of 3 months, every day, better, 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 week after week, better, 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 that's what people start telling you. And then they go the other way, and you feel going, oh my God, can we lock? Did you get my lock last night at midnight when I completed my loan application? No, I was not awake at midnight locking your loan when you did your loan application. So it's just like, it's bipolar. It's like two sides to it. And if you have a smaller loan and the savings isn't that large, totally get it. But we need to have that conversation. And it's almost good now that rates are a little bit higher, because we can have a low stress conversation where we're not talking about, no one's trying to sell you on a refinance. The girl I talked to today, her rate would be 6.625 today. She's at 6.375. There's no conversation about should you refinance. It's at what point would it make sense? We can strategically sit back and say, here's the approximate cost of the refinance. Here's what it would look like in terms of monthly savings. Now let's pick up that conversation when rates hit there. It doesn't mean that you're saying, I am absolutely positively going to do this. Again, her situation was like a $300,000 loan. Most of my clients with $500,000, $600,000, $700,000 loans, if we're talking 0.5% savings, 0.75% savings, it's a big movement in the monthly payment, and you're just going to do it. And the ability to do in lower cost closing states like California, if you can do low cost refinances with a recoup of 6 to 12 months, you're basically insuring yourself against rates not going lower in the future.
All right, good stuff. I just lost a headphone by touching my head here, Josh.
Don't touch your head.
There we go. Just one simple question. It doesn't, this is not for most people out there, but question of asking, how do you get approved in some states and not the others, Josh? So is there licensing that's required in every state? Do some licensing allow you to do multiple states? How's that work?
100%. And let's look at one of the ways that we decide how to do this. We look at the inquiries from the show and we go, where is everyone located? So the states that we're licensed in covers probably 88% of the inquiries from the show. But there's more that goes into it. So let's take an example. I think we're not licensed in Minnesota right now. very infrequent inquiries, like 2 or 3 a year from there. Smaller loan amounts, fewer inquiries. There's a cost of getting licensed, maintaining licensing, all of that fun stuff. Other stuff like New York, I've got 2 inquiries from the podcast this week in New York. We are 2 years into what is expected to be a 3-year licensing process. So some of these just take forever. Nevada was the better part of 2 years for our company to get licensed there. So a lot of it just comes down to time, effort, energy, and money to get and maintain licensing, and then the potential payoff in terms of how many people are there looking to borrow.
All right, good stuff. We're got about 5 minutes left, guys. Not a lot of questions here, so put them in there if you have them. Otherwise, we can cut early, and I
You
can get to
missed this
conference.
one.
Let's see
You
it.
missed this
What do we
one,
got?
Jeb, because there was no question mark at the end.
Ah,
Deerfield Disc Golf says the Fed has to lower rates over the next year or two. So isn't it guaranteed that rates will be lower 2 years from now? Is it guaranteed that
nothing.
rates will be lower 2 years?
Nothing in life is guaranteed. I mean, the reality is yes, the Fed is likely to continue lowering the Fed funds rate. It's very likely that mortgage spreads are going to improve. It's likely that the economy is probably not as in as good a condition as we think it is at the moment, which softening economy, all of these things that we just talked about likely leads to lower interest rates. Now, is that a guarantee? We've seen it's not a guarantee. I mean, the Fed kept interest rates too low for too long. They kept the federal funds rate too high for too long in some degree, and well, I guess that's to be determined at the moment. So again, we don't know what we don't know. That's why it's one of those things that we talk about. The refinance or wait, buy or wait. Wait for what? What are you waiting for? Right. This is the time. There are certain benefits to doing things now, and there's certain benefits to doing things potentially later, right? There's potential benefits to doing things later. You don't know what you don't know. You know what is going on right now, so you got to take advantage of it when it makes sense. I mean, we can ponder that question for the next hour and really not come up with anything other than what I just said. So,
Jeb, we got an
yep.
interesting one here.
Mm-hmm.
Lord Sniphar says, question from last
Ooh.
week. I got quoted 5 5/8 VA, $875,000 loan with 20% down, credit over 830. Should I keep shopping? Well, the answer is you should have locked the interest rate last week when you got that quote. I am shocked at how many people do this. They're going to do this shopping process, and they're going to call one lender, and then 3 or 4 days later, they're going to call another lender, and then a week later, they're going to call another lender. It could work out the other way. Rates could have been going down, and they could be better today. And I get that. We'll talk to someone, and then 10 days later, they call back, or we follow up with them. Hey, I haven't heard back from you. Oh, I got a better quote. Okay, cool. What was it? All right. When was it? Yes. Well, you realize that rates are lower from when we talked 10 days ago. So we've said this 1,000 times. You need to shop with all of the lenders on the same day, preferably within a 1, 2, 3 hour window. You need to get the numbers back from them and make a decision. And it's not all about interest rate. 5.63 last week was a really good interest rate. It's likely going to be higher today. And from that perspective, you got to be ready to make a decision. And the decision isn't all about the lowest rock bottom interest rate, because the headaches, the hassles, the tears that we get in emails from people are largely from the ones that called 52 lenders and got the lowest of the 52 lenders to quote them a rate and then lead them down a primrose path and didn't end up happily.
All right, Josh, you got a couple questions, just a couple minutes left. Let's try to fly through these if we can here. I think some of these are good questions that we don't typically get all the time, so let's address them. This one says, has the sort of spike happened in previous cutting cycles? The answer is yes. Rates typically move up after the Fed cuts, and we talked about why. There's a couple of different things going on right now than typically speaking, but again, a lot of it's baked into the cake, right? The Fed, the market knows what's coming. They built in this expectation. It happens. Data, in this case, jobs and whatever, a little bit higher CPI. The idea that the Fed might not do a rate cut or as aggressive rate cut, all of that factored in, and now we have higher rates, right? On top of the stuff that we mentioned at the top of the show. If you mentioned the top of the show, if you missed rather, go back and check it out, because we talked about the political piece of the puzzle that is now playing a part in this whole deal, which again, we talk about why and whether or not it makes sense and all of that. So go check out the beginning of the show if you haven't done so. Josh, this one, they have a Cal FHA down payment loan. They have a down payment ass loan.
Down payment ass loan.
Yeah, this is a new type of loan. It's an ass loan. That would complicate the refi. Do they have to pay that off before they can refi, or do they put that on the new loan? You put the new ass loan on the loan.
This is another reason why I do not like Cal HFA loans. Back in 2019 or so, they stopped offering the ability to resubordinate their second and third lien mortgages. So you have to be able to pay them off. So assuming they are purchase money loans, so they can be done in a normal refinance and they're not considered cash out, but your home has to have gone up enough in value that the loan to value makes sense. So they will need to be paid off. You shouldn't need to pay them out of pocket. Most of California has been creeping up over the last few years.
All right, good stuff. Tyler says, happy to be with you again on my loan estimate. Box A says points are being paid $5,900, but the percentage was left blank, like this, blank percent. So do I not know what the percent, the 5.9 is getting me? Thanks. So they basically have cost on there saying, hey, we're buying down the rate, but there's no rate. So what are we looking at here, Josh?
The only thing the percentage is, it's not telling you how much they're buying it down. It's saying what percentage of the loan amount that equals to. So just take that 5,900 and divide it by your loan amount, and it'll tell you what the percentage is. They don't have to put in the percentage. Most softwares do, because that's the way we're going to quote it. But if we say it's $5,000 for that, $5,000 might be 1.234 points on that. It doesn't have to be disclosed to you as a percentage, but it does have to be disclosed to you as a dollar amount, and that cannot change from a locked loan estimate without a valid change of circumstance.
There you go. Good stuff. We addressed this one earlier, but quick recap. What's your opinion on Democrats planning on helping out first-time homebuyers with a $25,000 down payment assistance? If they win, do you think this will drive prices higher? So we talked earlier, Josh, why bipartisanship is important in presidency and elections and anything. And it's, my guess is if you get some sort of bipartisanship in the House and the Senate, Congress, whatever, that there is probably not the passing of down payment assistance grants and that sort of thing. Somebody's going to oppose it. What are your thoughts?
It's the dumbest idea in the history of the world. And it's not because the Democrats have that idea. It's anyone that proposes this idea. We had, why am I drawing a blank on our guy that we had on the show? Ed Pinto, the American Enterprise Institute.
Yep.
And one of his quotes in there is that the government, Republicans and Democrats, is very good at goosing demand. They are not good at providing enough supply. We have a supply problem versus a demand problem. There is a demand problem in terms of affordable demand, able demand, people who can buy. So this thought is, hey, $25,000 is going to change that. That's the biggest hurdle, is getting over having that $25,000. Well, you're not really helping affordability because you have more able buyers chasing the same limited supply of homes. It would increase the value there, or the prices of homes. So it doesn't solve the problem. For the people that get the assistance, it solves their problem, but it's going to help a very small subset of people at the risk of exacerbating the problems that everyone is already suffering from.
All right, we're going to do another question here. But before we do that, if you find any value tonight, do us a favor, hit the thumbs up. Like the show, subscribe to the channel if you haven't done so. If you need help with mortgage assistance, check rates, you want to get pre-approved, jebsmith.net/referral will get you in touch with Josh and our team here to help you with that. Josh, this question here, is it common that preferred lenders, we'll use the quotations there, often offer higher rates to offset incentives?
So the whole BS of builders giving you these big incentives and their preferred lender, it is never a preferred lender. It is not, I shouldn't say never. It is 90% of the time the wholly owned subsidiary of the builder. So the builder owns a mortgage company. So they're moving money from here over to here. And we've talked about this before on the show. I had a friend of mine bought a $550,000 house out in the Menifee area, $30,000 credit from the builder. So from the builder to the builder's lender, they owned both of them. And the $30,000 was really $18,000. when you look at what she could have got on the open market. So are they inflated? Yes, it's inflated. But in her situation, she was getting $18,000 that no one else in the world was going to give her. And how do builders do that? The builder that owns the builder and the mortgage company, they do that because they have 20 to 30% margins in a $550,000 property. They're making $100,000 to $150,000 on that. Giving up $18,000 to move it on and move on to the next home that they're going to sell is a reasonable investment for them.
All right, last one. Josh answered your question about 5 minutes ago, so go back and watch the show. Until next week, guys, buy right, borrow smart, build wealth. Adios.
Amigos.